Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Cipher Mining Inc., or CIFR, a company that has been, well, fundamentally rewriting its business plan at a truly dizzying pace.
It really has.
And this deep dive is all about analyzing the dramatic, genuinely transformative strategic pivot underway at this infrastructure player.
And that pivot, that defines the entire central investment thesis right now. Cipher is betting a staggering $8.5 billion in binding contracted revenue, backed by hyperscale tenants like AWS and Google, will fundamentally establish it as a hyper-growth, high-performance computing, or HPC, lesser.
Right.
And this whole strategy is designed specifically to offset the inherent instability of Bitcoin volatility, and also to address that recognized material weakness in internal controls that the company currently discloses.
$8.5 billion in contracted revenue. That is just a staggering commitment.
It is.
It tells you immediately this is not about simple diversification. It's a full-scale, winner-take-all transformation into a specialized HPC data center developer.
Absolutely.
So our mission today is to unpack this massive leap of faith. We'll start with the current financial foundation, then dive deep into those ironclad contracts that form their revenue moat, and finally assess the significant execution risks involved.
And we really need to define the financial mechanics they're using to fund all of this.
So let's start right there with the current scorecard. This rapid strategic shift happened concurrently with, the daily grind of running their legacy business. What does the balance sheet and P&L actually look like for the third quarter of 2025?
Well, the financials for Q3 are fascinating because they show this simultaneous strength in the legacy Bitcoin mining business while they are spinning up the HPC effort.
So the old business is still firing on all cylinders.
Exactly. Despite the company's forward focus, their Bitcoin mining revenue reached $71.7 million. And that's an impressive jump of, 65% quarter over quarter from Q2?
A 65% jump in mining revenue. That's massive. It suggests the legacy business is running incredibly efficiently.
It is.
Is that strong operational performance throwing off enough cash to cover the basic operating expenses, the OPEX, for this enormous transition?
Absolutely. And the profitability metrics confirm that the Bitcoin cushion is very, very strong. Adjusted earnings also saw a significant surge, hitting $40.7 million in Q3.
Okay.
That was up 34% quarter over quarter from Q2. But, while that operational cash flow is great for stability, the balance sheet truly reflects the sheer magnitude of the new capital activity.
The activity aimed right at funding the HPC buildout.
Precisely.
So tell us about that liquidity injection. We saw the news of that massive zero-coupon convertible note. That's where the real construction money comes from, right?
Indeed. The financing activities led to a massive increase in cash and equivalents, giving them about $1.2 billion in total cash and liquidity at the end of Q3.
$1.2 billion in cash.
And that buffer stems largely from that new $1.3 billion convertible note offering. They have the cash runway now to start pouring concrete and buying gear.
That's a huge injection. But these high-profile, complex deals, they must introduce new accounting complexities, new liabilities. I'm looking at one specific item here, the $512.6 million warrant liability. What is that, and why is it so large?
That's a crucial detail. It tells you exactly how the Fluidstack and Google deal was structured. A warrant is essentially a right to buy the company's stock at a set price later on.
Okay.
The company recorded that $512.6 million liability because Google received those warrants as part of the deal.
So in exchange for what?
In exchange for providing critical security acting, essentially as a credit guarantor, on a huge portion of that lease, Google gets skin in the game.
Got it. It's a mechanism to de-risk the project financing, but it has to show up on the balance sheet as this big liability.
Exactly.
Okay, that clarifies the cost of getting Google to sign on. So let's transition now to the centerpiece of this whole pivot, those contracts. These hyperscale agreements are the entire reason for the market's enthusiasm and that $8.5 billion number.
They are. These two monumental deals truly define Cipher's new HPC moat. First, they secured a massive $5.5 billion contracted lease with Amazon Web Services.
$5.5 billion with AWS.
And this is a 15-year commitment utilizing $300 million capacity at their Black Pearl facility.
A 15-year, $5.5 billion anchor lease with a blue-chip tenant like AWS is.
Well, it's truly foundational. It immediately shifts the perception of Cipher from a volatile miner to a stable infrastructure lessor.
It completely changes the
And
story.
what about the Fluidstack and Google deal?
That's the second equally important pillar. It's a major contract for $3.0 billion over 10 years, using 168 milliW at the Barber Lake facility.
Okay.
But here is the critical security detail. Google directly backstops $1.4 billion of Fluidstack's lease obligations. Wait, hold on. If Fluidstack is the tenant, why is Google guaranteeing $1.4 billion? Does that mean if Fluidstack defaults, Google actually has to pay Cipher?
Exactly. This is the de-risking element that gives institutional investors all the confidence they need. Google's credit strength essentially secures that portion of the lease, providing critical security for financing the project debt.
I see. So you aren't just relying on Fluidstack's credit profile. You've got one of the biggest companies in the world standing behind a huge chunk of it.
You've got it. It's why the whole structure works.
And what about profitability? If they're moving away from Bitcoin mining, which, as you said, is showing great margins, what kind of returns do these long-term leasing deals offer?
The potential profitability is, well, it's immense and just fundamentally different from mining. These deals are expected to generate incredibly high margins. The prediction is in the 80% to 85% net operating income or NOI margin range.
80 to 85%. For our listeners, can you quickly put that NOI margin into context?
Of course. NOI essentially means your revenue after paying for direct operating costs like power and routine maintenance, but before things like depreciation or interest.
Okay.
So a stable 80% to 85% OI margin means that for every dollar of contracted revenue, 80 to 85 cents are dropping straight to the bottom line year after year.
That level of contracted long-term stability, it's just vastly superior to the volatility of Bitcoin mining.
It's a completely different class of asset. And to understand the future scale here, we have to look beyond just these two anchor sites. Their total Texas development pipeline stands at a staggering 4.0 GW across roughly 12 sites.
4 gigawatts.
And crucially, 3.2 GW of that massive pipeline is specifically prioritized for future HPC applications. This cements the strategy for years to come.
4.0 GW is the capacity of a small country. How is a company currently known for Bitcoin mining suddenly managing that sheer volume of development? And more importantly, how fast can they execute this compared to traditional data center developers? Speed to market is everything in the AI race.
And that is their entire pitch. That's their differentiator. Cipher claims it can deliver HPC capacity up to 2 years faster than traditional development cycles.
2 years faster. How?
They aren't building from scratch. This acceleration is achieved by recutting existing, already electrified air-cooled infrastructure, specifically the Black Pearl site, and rapidly converting it. They're skipping the years of waiting for grid connections.
So repurposing is the key. But the timelines still sound aggressive. Are we talking months or years until this massive revenue stream begins?
We're talking months, which confirms the urgency. They're targeting commercial rent commencement for the AWS deal by August 2026.
August 2026.
And the Fluidstack Google lease is expected to commence just 2 months later, in October 2026. This schedule confirms they're prioritizing speed over slow greenfield development. Flawless execution is the expectation.
Flawless execution is a tall order. But while these HPC towers are being built, what's supporting the company and how are they funding construction without diluting shareholders? That comes down to capital discipline.
The Bitcoin cushion at the Odessa facility is providing that crucial stability. The 207 MW Odessa facility operates under a highly valuable fixed-price power purchase agreement, a PPA, that runs through July 2027.
A PPA is a long-term contract for power, right? So how does that benefit them?
Correct. It means they've locked in low-cost power for years, insulating them from volatile energy markets. Management explicitly said this makes Bitcoin mining a fantastic business there, providing highly reliable, low-risk cash flow for the next 2 years.
So it's covering the lights and salaries while they wait for the huge HPC rents to kick in?
That's it. And on the funding side for the HPC construction, that $1.3 billion was secured via a zero-coupon convertible note.
And that was the one that was hugely oversubscribed.
It was. Reportedly 7x oversubscribed, which signals extreme market confidence. And critically, to manage the dilution risk, they used capped call protection.
Okay, capped call protection. For listeners like me, how does that structured financial tool actually prevent dilution down the road?
Think of it like an insurance policy against your own stock price skyrocketing. With a normal convertible note, if the stock rises dramatically, you have to issue millions of new shares when bondholders convert.
Diluting all the existing shareholders.
Exactly. Capped call protection limits that exposure. It effectively raises the conversion price, in this case, to about $23.32 per share. Management says this structure eliminates the need for further equity fundraising for these buildouts.
So they got the cash without immediately punishing shareholders. Okay, let's synthesize the whole investment case here. We have $8.5 billion in contracted demand, a huge 1JW Colchis site acquisition boosting the pipeline, and seemingly disciplined financing. Is this the definitive AI infrastructure play, or is there massive risk here?
It is undoubtedly a high-stakes, high-reward bet, and you have to balance the opportunity with two critical risks, execution and structure. First, the execution risk. It is paramount. The full revenue stream doesn't hit until late 2026. The company faces projected unprofitability until fiscal year 2027, relying entirely on flawless, rapid execution. Remember, Barber Lake rent starts October 2026. AWS starts August 2026. Any slip-up pushes profitability further into the future.
That is an incredibly thin window for error. Now let's talk about the structural risk that keeps appearing in their filings.
The structural risk cannot be ignored. The company continues to disclose a persistent material weakness in internal controls over financial reporting.
Okay, that's still there.
It's still there.
Yeah.
While management is actively working to remediate this throughout 2025, a known weakness like that directly impacts investor confidence and the reliability of their reporting at the exact time they are managing billions in complex agreements.
So the final investment case really hinges on whether the security and magnitude of that contracted demand justify the current valuation arbitrage, or if this remains a high-risk gamble that demands perfect execution to overcome these known structural and financial headwinds. Exactly. It's a binary bet. Perfect execution means enormous value creation. Any significant delay, especially coupled with that internal control weakness, could erode confidence instantly.
Considering the massive influx of capital, the complexity of these new HPC agreements, and the need for institutional trust, how essential is it now for the company to prioritize the definitive resolution of that persistent material weakness in controls to truly secure long-term credibility going forward? That's the question you, the investor, have to answer. Risk defined, portfolio protected.